Financial Forte. Listen in, ding-a-ling-a-lo to our radio show. Financial Forte. Financial Forte.
Good morning, listeners. I am Paul Waite, and I'm joined by...
Sandro Forte.
Oh, you knew your name.
Well,
that's fantastic.
We've never done that before. No one.
Don't tell people about that. I found out about your training exercises earlier. It's quite disturbed me, to be honest. So, Mr. Forte has come back from Barbados.
I have. It was lovely. The weather wasn't very good, but first world problems. But it was very nice. It was nice to get a break. And my daughter, Ellie, got engaged while we were there. So that was nice news.
Oh, how lovely. So, what does this chart tell us? Mr. Forte exercises sound financial planning. This means he can go on very expensive holidays to Barbados, while the rest of us are left in dreary old Angleterre.
Well, at least I practice what I preach.
Exactly. No, it's good. So today we've got a really exciting subject for you. Sandro is going to demystify, his words, not mine, demystify the world of pensions, aren't you, great guru?
I'm glad you broke...
Great guru Nanak.
I'm glad you broke everyone into that one. It's a very dry subject, but very important. So I thought, since you and I are getting ever closer to that day, Paul...
There you go again.
I thought today we'd deal with pensions. We'll keep it nice and simple.
I'll have my lawyer in on the next show, I think. Right, so what about pensions? Where are we going to start then?
Well, should we start with the basic
Start
old
at the
age?
very beginning. Very good place to start.
This is going to be a long hour, isn't it? I can tell.
Yeah.
So I thought we'd start in the most obvious of places, which is the old age pension. A lot of people don't know how it comes about, how it's earned. So I thought we'd better start with that one. And then we'll kind of break it down. We'll talk about national insurance and how that contributes towards basic pension that we're all entitled to a greater or lesser extent. And then we'll talk about the various classes of national insurance. And I've got a couple of lovely tips to help people find out where they are and what they can do to improve their overall pension position when that day comes.
So you're going to tell us how much people get, etc. as well?
Yeah, absolutely.
Because I must admit, I'm supposed to be a financial expert and I'm not entirely sure, how much people get, to be honest.
Okay. Well, you're about to find out, aren't you?
I am.
So let's start, if we may, probably in the most obvious of places, which is old age pension. A lot of people refer to it as that. And there's a couple of anomalies here because a lot of people think that they're all entitled to the same amount of money, which is not necessarily the case. So when we talk about basic state pension, we are talking about people, females, born before the 6th of April 1953 and males born before the 6th of April 1951. So if you are one of those people, then your basic state pension is currently £141.85 per week. There is a little caveat here because you have to have had 30 years of full national insurance contributions to qualify for that basic pension. So if, for example, you've got 15 years of national insurance contributions, you'll get 15/30ths, so half of that basic state pension entitlement. We'll talk a little bit about how you qualify for that.
So one of the things that staggers me, I have to confess, I'm not really au fait with the world of universal credits and housing allowances and even pensions. What staggers me is the increasing number of people that I know who basically have no money, and the government won't give them any money at all. So you're sort of brought up to think that there are a lot of people sponging off the system, if you don't mind me saying that. So you've got these, families of 8 kids that, living in 5-bedroom houses getting thousands of pounds. And yet I know real people who have no money and the government won't give them anything. So £141 a week after working for 30 years, I don't see how you could live on that, to be honest.
The one thing I love about this show, Paul, is we always ended up having a political conversation about state benefits.
I don't think it's political.
I agree. I do agree.
It's not meant to be political. It's just meant to be. So if you don't, it's not. It's a yes or no, isn't it? Is £141 enough? I don't think it is.
Well, let's take that one stage further. If you consider that the tax rates, we all know what they are. They're either nil, they are 20%, 40 or 45%. If you then, we'll talk about national insurance in a moment because that's an essential part of pensions. If you add on, 13+% national insurance, and that's the employee or self-employed contributions, depending on which side of the fence you sit. The marginal rate of the overall amount of tax that we pay oftentimes is in excess of 60%. So if you take your point, 30 years paying 60%, let's take that as the number, might be more, might be less. That's an awful lot of tax to be paying to then receive £141 a week. So I agree with you. It seems a trifling amount of money, but there are, of course, lots of solutions as to how people can solve that problem. So we'll talk about that as well today.
Assuming they have the means to do so, of course.
Of course.
Which sort of puts us into different camps of people, doesn't it? The enlightened, the people who can afford it and do nothing about it, and those who can't afford it.
Correct. Yeah, we'll try and tackle all three of those.
Hell yeah.
You've got that mischievous twinkle in your eye today, Paul. This is going to be...
This is the show of mirth brought to you by Forte and Weighty.
Do you know what? Thinking back to the 80s and Steve Wright in the afternoon, it kind of feels like that now.
Really? That's an insult.
Is it?
I'll tell you a true story. I actually went to... There used to be a nightclub in Bridgewater called the Crow's Nest, and Steve Wright actually was hired to go there, so I went. And it's quite funny sometimes you see... It wasn't a surprise to me because I'm not a Steve Wright fan. But some guy decided it was funny to crack an egg on his head. And he did not have a sense of humour. I'll never forget that.
I think I went to the Crow's Nest in about 1982, and I remember getting stuck to the floor.
Yeah, well, it's an entertaining place.
No disrespect to the clothes.
Anyway, going back to pensions. Sorry about this. Dragging you bang to my level, you see, because I feel happiest that way.
Yeah, well, absolutely. And I look forward to this every single month. The days and months don't come quick enough. And then, of course, we've got the individuals who have retired on or after the 6th of the 4th, so 6th of April 2016. That's what we refer to as the new full state pension. That's £185 and 15p a week.
Sorry, hang on a minute. So are you saying that older people get less money than younger people?
I am, Paul. I am.
How can that be right?
There are two different forms of old age pension. Again, but that's the way the system works, because there was a reform of pensions a number of years ago, and the new state pension, again, national insurance contribution related. We'll talk about that. But what we've now got, of course, is an increase in the state pension age. Most people assume it's 65. It's now 66, and it goes up to 67 in 2028.
For men and women?
Mm-hmm. Equalised now.
That's true equality.
It is. That's the way it should be. Even though men are still dying slightly younger than women, so they get to claim their pension benefits for slightly less time on average. But yes, we'll talk about national insurance and how we come to qualify for these benefits. And I can't wait. Can't wait to know what you've got lined up playlist-wise today.
I'm recoiling in social dismay at the moment. I'm just sitting there thinking, I never thought that I would become such an ardent humanitarian socialist as I have become.
I don't know how to answer that particular observation, but yeah, it's a tough bullet to bite when you consider you've given the state everything for say 30 plus years, and then that's what you get back. It doesn't seem very fair.
No, it's not trying to be political. I'm just really trying to understand how we're talking about most people probably how most people can live on 140 or 180 pounds a week. When you consider that electric bills might be a third of that or something now. Mm-hmm. You're lucky to have fish and chips once a week or something. That's as good as it gets for you, isn't it?
Yeah, I mean, generally speaking, pensions have been indexed. They've risen with inflation for most of the time I've been in business, 31 years. But nevertheless, if you then factor in current energy prices, which are and the cost of living currently, they are rising far in excess of any increases in pensions. So there's a disparity now. There's a growing gap between what people need and what people actually receive.
So welcome back to Alessandro Fortissimo Massimo Maximus Decimus Forte.
You need to stealth that Red Bull, Paul, honestly.
Right, let's get back. Come on, exciting things about pensions.
Exciting is not a word you'd use, but I'll try and demystify it, as you said earlier. So I've already alluded to the fact that to qualify for basic pension or new full state pension, as I've mentioned, you need to have acquired a contribution history in terms of national insurance. So as most people will probably be aware, if we are employed, and I'll separate employed and self-employed just for clarity, if we are employed and we are earning at least £190 a week, that's what we call the lower earnings limit, there will be a national insurance deduction from our salary, typically taken by our employer and paid to HMRC. And we call that Class 1 national insurance. And that comes at a certain rate, which is currently 0% up to £190 a week. But once we earn in excess of £190 a week, we pay the grand total of 13.25%.
Shocking.
It is shocking, which has risen quite considerably, as we know in the last manifesto, the last time we heard the Chancellor speak on national insurance at the last election, we were promised no tax increases, and then, hey presto, we had an increase in national insurance, which is an indirect form of tax. So it was a
I think I am going to say something political now. My wife was very upset with me. So she says to me last Thursday, are you going to come and vote now? And I said, no. And she said, well, why not? And I said, because I told you, I spoke to Boris Johnson and told him I was never going to vote Tory again. So what's the point of me writing to him and saying that if I do? So I didn't. And if you don't want to know why, check out my wonderful article, The Betrayal of the Business Class by the Tory Government by Paul Waite. And you'll see exactly why I don't vote Tory.
In a good bookshop near you.
Published.
I haven't read that, actually. I'm going to have a little look at that. So what we know is if you earn below the lower earnings limit, there's no national insurance payable. Anything in excess of £190, up to £967 a week is 13.25%, and anything in excess of £967 a week, if you're lucky enough to earn that much money, then you pay an extra 3.25% on anything over £967. It did. It's gone up quite considerably. So going back to the comment that was made earlier, if you consider tax at 0, 20, 40 or 45, then throw in an extra 13.25% national insurance, and we are paying a large chunk of what we earn in various forms of tax. So once we've got at least 10 qualifying years, so in other words, we've paid national insurance at one of those levels for a period of time, at least 10, then we start to qualify for old age pension, I'll call that for universal purposes. There is actually national insurance credits that you'll probably be aware of, Paul, that is available for non-earners. And what I mean by non-earners, this might be somebody, typically a mother, historically at least, who's brought up a child at home and hasn't been able to work, somebody who's looking after somebody with a disability, or, back to your earlier point, somebody claiming certain benefits. So we can gain national insurance credits even though we haven't worked and paid national insurance.
Yeah, something else I wanted to say. I think you can also actually voluntarily make payments after the event if you missed a year.
Paul, you're stealing my thunder.
Oh, sorry.
But yes, you're well informed. That's correct. You can.
Well, no, because obviously I know about these things. But,
that's called Class 3 national insurance. We'll talk about it in a minute.
Okay.
Don't ask clever questions because you're gonna steal all of my thunder. So that's Class 1 for employed people. And actually, I'm going to share, if I may, a kind of a relatively unknown fact. So everyone has a national insurance number. Some know it by heart, some don't. My national insurance number ends with the letter A.
So does mine.
Does it? Okay. Well, let me tell you something. Not many people know this. Your national insurance number is not a randomly generated number. The letter that comes at the end of your national insurance number is very important because what that does is it tells us a number of things. And we'll talk about what that tells us shortly. The other thing I just want to mention before I forget is that your employer, if you are employed, while we're on that subject, will also pay national insurance. So in addition to tax and national insurance that we pay, your employer will also pay national insurance at the rate of 0% if you earn up to 175. So it's not aligned with your national insurance, obviously, because that would be far too easy. At £175 and a penny a week, plus it's 15.05% now, which has also gone up quite considerably from what it was before. So add all those numbers together, and it's an awful lot of tax, direct or indirect. Well,
it creates a disincentive to employ people, doesn't it?
It does. It's one of the big dilemmas. One of the big dilemmas for employers, yeah. And then we're going to talk at some point about auto-enrolment, which is the new pension regime.
Oh, do we have to?
Well, you don't have to, but there are a lot of people ask lots of questions. And actually, Paul, you don't know this, but I've received a number of emails from your listeners over the last month asking lots of questions, which is actually what's led me to talk about pensions today, because I've had more questions about pensions than anything else.
How wonderful. Thank you, listeners. So all 4 of you that listened to me and Sandro.
And I've had emails from 3 of them. How lovely.
That's very good.
Yeah. Employer national insurance. So that's class 1 national insurance. That's the employee paying that. Couple of little tips for people, since I've mentioned state pension. There is a way to get a state pension forecast. So every listener can go to www.gov.uk. All you have to do is type in, or you can just put in a Google search, state pension forecast. You'll get directed directly to the government website, and you can get a state pension forecast for free. It's instantaneous. You put in your basic information and you press a button, and it tells you exactly, based on your current national insurance record, what you're entitled to receive as far as old age pension is concerned when the time comes.
Obviously, I've already done 30 years, so,
Then you'll be entitled to full state pension.
Yeah, by the time I finish, it'll be about 65 years, I think.
There is actually, if you also put in check NI credits to the same search engine, it will also tell you, so I will now cover the point you've just made, it will also tell you about whether you've got any gaps in your national insurance record. And you're absolutely right, you can go back up to 6 years and you can fill in any gaps in your national insurance record. And that's important, because that will help boost your old age pension.
It will. Isn't it sad? I was thinking that, so if you do less than 30 years, technically you don't get the full pension. But if you made 50 years, you don't get any more than someone who did 30 years.
That's right.
Because life is full of unfairness, Sandro.
It is. Life's not unfair if your national insurance number ends in the letter B, because you pay a very, very vastly reduced sum of national insurance.
Why would your national insurance number end in B?
I don't know. But it can end in A, B, C, D, E, F, G, H, I believe. It goes all the way up to I. I might be wrong on that. But generally speaking, most of the categories, most of the letters will correspond with national insurance rates at 13.25 for employees and 3.25 in excess of 967, as I've already mentioned, a week. I think those that have the letter B at the end of their national insurance number, they pay something like 3%. It's a very, very small amount of national insurance. And I believe it might have something to do with service in the armed forces or something like that. I'm going to throw my hands up and say I don't actually know the reason why. But if you are lucky enough to have B at the end of your national insurance number, you're in a very fortunate position from a national insurance perspective.
So, if you are serving in the armed forces, or you have served in the armed forces, such as my best mate Andrew Lauder, ex-member of the RAF regiment, do let us know what B stands for and why you only pay 3%.
I'd love to hear from any listeners who've got B at the end of their national insurance number.
Attention!
Yeah.
See to it, soldier.
I was guessing about the armed forces thing. It might not be that at all, but...
sounds reasonable.
Yeah. So I'd love to hear from anyone who's got B at the end of the national insurance number, because I've never met anyone that has that letter. Maybe somebody just made it up.
Anyway, I'm just going to share something with you, Sandro, on a personal level. I'm on the radio Wednesday, Thursday, Saturday and Sunday this week.
Are you?
Yeah. Obviously today with
hosting
you.
Hosting or guesting?
Today with you. And then on Thursday, I am a guest on the Scenario Show with Nathaniel Warren, where we are talking about the post-apocalyptic world. Nathaniel is going to be representing the sort of it's all ended, and I, of course, as an optimistic person, I'm going to be representing the life must go on.
Oh, it's like an old school debate then.
So, well, not so, yeah. So I've picked songs like "The Show Must Go On" by Queen.
Okay.
"Happy Shiny People" by R.E.M. So check it out, 7:00 on Thursday. I thought I'd say that.
I love that. That's great. I'm definitely going to tune in.
And this week on Saturday, the featured artist is Glenn Campbell. Legend. Anyway, so our next, how can you have Stock, Aitken and Waterman without "Never Gonna Give You Up, Never Gonna Let You Down, Fool Around and Desert You"? Yeah, baby. So it's Rick Astley. Welcome back to Financial Forte with Paul and Sandro. How could one have a show dedicated to Stock, Aitken and Waterman without the delightful Kylie Minogue? I have to say, Minogue, as I call her family come from Wales. Do you know that originally?
I don't think I did know that, actually.
Yes, so Minogue is a Welsh name, so the Minogues originally come from the valleys. I have to say, just being a bit of a tarty man for a minute, I preferred Danny, from a boy's point of view.
I can't possibly comment, but I think I might agree with you.
But I have to say, it's funny the way that British people are. There's certain people that we take them to our hearts, and she was one of those. I would think Kylie Minogue would be one of maybe the 10 most popular British human beings that British people like, because it wasn't because obviously she's Australian. And I just think it's funny, isn't it, how people mature over time. Start out as this slip of a girl, and she's become something quite special. I don't know if you saw the Doctor Who Christmas episode that she was in, for instance, and she was delightful in that, I thought.
I just think she is one of those people that's managed to stay out of trouble, and that's not an easy thing to do in this day and age. But yeah, there's always been a kind of a... I think your word's right, Paul. She's always been very delightful in everything I've ever seen her in, certainly. I think she's...
But if you want to see the other side of her, read about her and Michael Hutchins. Anyway, we'll leave that, because you can just... If anybody knows anything about Michael Hutchins, then you might have an idea what I'm talking about.
He was a talented guy, let me say.
He certainly was. Genius. In excess. Anyway, pensions.
Yeah, where do we go after that?
Who wants to talk about pensions?
Do you know what?
I can say lots of Michael Hutchins if you want.
I have to say, there's a kind of double whammy going on here, Paul, that we haven't really thought about, but it's just crossed my mind. Not only are we trying to, and I don't know if I'm succeeding, but demystifying pensions, there's a lot of people out there going, didn't know that was by Stock Aitken and Waterman. They had, I don't know how many hits they had, but gosh, they were an institution, weren't they, in the 80s and 90s in particular.
Yeah, I would have thought maybe 30 a year for at least 10 years, something like that, if I had to guess.
That's why Pete Waterman is so wealthy, I guess.
Oh, I'll tell you something. Sorry, I know this, this has got nothing to do with pensions. I just wanted to do it as a brag, because I'm the only person who could do this. A question on Russell Osman's House of Cards this week was how many goals were scored in the first Premier League season? And I was only 13 goals out. And do you know why? I worked out how many... This is in my head. Yeah. I worked out how many games there were in a season.
Yeah.
Obviously, I know how many teams are in the league. I assumed there were 3 goals scored per match, and I was, 16 goals out. So I guessed 1,140, and it was 1,124.
I would have said that.
Yeah, there you are. Just goes to show what you can do, you see? Bit of planning.
Well, let me underpin that then with something really dry by just covering off the last 2 national insurance classes. Class 2, I've already touched on that. That is the class of national insurance that self-employed people pay. It's a fixed monthly or yearly amount. And then they also pay Class 4 national insurance, which is a percentage of their profits. So just to distinguish, 1, 2, 3 and 4, 3 being the voluntary national insurance contributions that we pay if we've got gaps in our national insurance record and we decide that we want to fill those little pots to make sure that we get as much old age pension as possible. So there's our national insurance stuff dealt with.
And the Cap 4 is capped, isn't it?
Yes.
Sorry, the Class 4 is capped.
It is.
So historically, it was actually cheaper to be self-employed.
Yes, it was.
But less so now.
Probably still cheaper.
Still is, but less so.
A lot less so than it was before, for sure. And then I touched on the dreaded auto-enrolment thing. A lot of people get very, very hung up and confused by all these new pension legislative rules and regulations. A lot of people say, what's the difference between stakeholder and I've got contracted out pensions from before, and what's the difference between a personal pension and a final salary scheme? We probably can't deal with everything today, Paul, but all I really wanted to do was to touch on auto-enrolment, which is the new form of pension that is now what's called an opt-in scheme. So in other words, it's compulsory, it happens automatically unless the employee decides to opt out. And the way it works, generally speaking, is that you as an employee will have 5% of your pay deducted and paid to a pension chosen by your provider.
Didn't it used to be 3%?
It did, but it's gone up. And now we've got 5% from the employee and 3% for the employer. So typically 8% of total remuneration ends up in a pension pot.
On top of the national insurance burden.
By the time we finish this chat today, Paul, we will all be cringing at the amount of...
So I started the show in a buoyant mood, and I shall end it in a...
feeling bereft and bankrupt.
Where is the nearest cliff?
And then, of course, once we've started to build up pension benefits of our own, whether through auto-enrolment, personal pensions, or maybe some defined pensions. That's the final salary schemes that many people refer to it as. Then, of course, we've got this lovely cap called a lifetime allowance, which means that basically once you hit a ceiling in terms of the total pension benefits that you've built up for yourself, and I'm not talking about basic pension now, I'm talking about one's own personal pension arrangements. Once we hit a threshold of 1,073,100, which sounds like an enormous amount of money, but actually it isn't, because normally, and I'm talking generally here again, one can take up to about 25%. It varies slightly, but I'll stick with the basics. One can take up to about 25% of their pension pot as tax-free money, tax-free cash, and the rest, so in this particular case, just over 750,000, as a pot that from which they can then draw a pension. But if you think that to sustain a lump sum of money, to provide income over a sustained period of time, we normally reckon about 4% is a good yield, a good level of income to take from a pot. So at 750,000, we're only really talking about £30,000 a year. As
a pension? Or?
As a pension, as an ongoing pension. And if you then bear in mind that that is taxable income, so the double whammy, you've been paying all this tax and national insurance throughout your lifetime, and then the government, HMRC, are going to take some of that back in tax from you when you retire if you earn more than the personal allowance, currently £12,750.
And then we get back to the manifest unfairness again. So somebody who spends all their money on alcohol is actually in a better tax position than someone who saves.
That's absolutely correct. I'm just going to correct myself. £12,570 is the personal allowance, not £12,750. But yeah, that's a fair observation. So we've got this lovely threshold.
Socialism beckons. Viva Libertad.
I've got a long way to go to convert me to socialism, but lifetime allowance 1,073,100. Now here's the stinger, because if we build up a pension pot that is in excess of 1,073,100, or whatever it ends up being when we come to take those benefits, we pay an additional rate of tax on the tax-free cash that we were previously paying no tax on. We pay 55% tax on the excess tax-free cash. So if, for example, to really try and keep this simple, if we've got a pot of, let's say, 2 million, then the first 25% of the 1,073,100, so let's call that 256,000 for cash, that's tax-free. But the 25% on the excess between 1,073,100 and 2 million, as I've already mentioned, that's chargeable at 55%.
Right.
Because it just is. What the government decided many years ago in its wisdom is they didn't want wealthy people to use pensions as a means of, because there's lots of benefits to using pensions. Inheritance tax exemption is one. Pensions don't form part of one's estate for inheritance tax. But what they didn't want was the rich to get richer, which is kind of it's the antithesis of capitalism, obviously, but they were fearful of the fact that a lot of wealthy people were shoveling in loads and loads of money into pension, building up enormous pots of money, and then not being restricted in terms of taxation. So when the Chancellor comes to create a budget, he or she is always going to be looking for the safest ways to gather revenue. And one of the ways to gather revenue is attack the rich. And although we're talking about entrepreneurialism and we want to encourage people to run their own businesses and build wealth, okay, but then they'll go and take from the other end. So the lifetime allowance is a very, very important thing to keep an eye on, because not only do you get the 55% tax charge on the tax-free cash, you then get an additional 25% income tax on the income you take.
So, final comment from Paul before we get into Brother Beyond, which is one of my guilty pleasures, actually. So it's actually I tease Sandro a bit about it being a big dollop of soft cheese, because it gives me an opportunity to hide behind that. So one of the things, I keep going about manifest unfairness, okay? So I think one of the basic principles of taxation should be relative fairness, and I think that's enshrined in doctrine, actually. So leaving aside the fact that I don't agree with it anyway, so I don't even think that 20% would be fair, to me it's manifest. So let's just say that you get, over your lifetime, 25% tax relief on your pension contributions, to then pay twice as much on the end benefit of that is manifestly unfair. So if they said, top rate taxpayer, you got 45% tax relief, so therefore when you take that, it's 45%. I could understand that, but actually they're deliberately skimming, aren't they?
Yeah, that's a good point. And the best pension outcome you can possibly achieve is if you spend all of your or most of your working life as a higher or additional rate taxpayer, so you're paying 40% or 45% tax, because that's the tax relief you're then getting on your pension contributions, as long as you then retire as a basic rate taxpayer. In other words, in today's money, earning less than £50,000 a year. Why? Because you've got 40 or 45% tax relief through your working lifetime, but you're only paying 20% coming out the other end. But that's an exception rather than a rule.
That was This Time I Know It's For Real. And Sandro and Paul are the real deal. So that is, I think, probably the best artist that Stock, Aitken and Waterman managed to persuade to join their little stable. So Donna Summer, I was talking about this on my Saturday show about 3 weeks ago. So Donna Summer had a bit of a drought in the 80s, so she didn't have a hit for a while. And so, of course, she was quite pleased when Stock, Aitken and Waterman approached her. And I actually think it's very different to all her other songs, but that's a really good song. So that probably is my second favourite Stock, Aitken and Waterman song, I would say.
I'm starting to find out more about you every single day, Paul.
Yeah. Donna Summer, legend. Anyway, Sandro Forte, legendissimo.
Your Italian vocabulary, I'm not sure it was necessarily improving, but I appreciate the effort. Maximum pension contributions.
Maximo, you mean?
I'm not sure it's Red Bull that you're on. It's definitely something stronger than that.
And of course, a pension in Italian doesn't mean that, does it?
No, it doesn't. It doesn't.
Yeah.
Oh, well done, Paul.
Yeah.
Very good. You've got his little phrase book out. So maximum pension contributions. I did have an email from one of the listeners saying, so what can I pay into a pension? The simple answer is, and this is there's been a lot of misunderstanding about this. Technically speaking, we can pay in anything we want to into a pension. Some people think that it's limited, and I'll caveat what I'm about to say. But technically speaking, you can pay any amount you like into a pension. However, if you exceed the limits, I'll talk about those in a second, then you are liable to pay tax on the excess. So you can pay money into a pension in excess of the limits, but it's not very tax efficient because you'll actually suffer a tax charge by doing so. So what are the generally accepted limits? Well, for tax relief purposes, 100% of your income or £40,000 a year, whichever is the lower. So if you're lucky enough to be earning £100,000 a year, in theory, you can pay up to £100,000 into a pension. However, the limit is still 40,000. So to get away with paying 100,000, because 40,000 is the lower number, you can go back up to 3 tax years. It's called carry forward, just to make it really, really complex. We can go back 3 tax years. So including the current one, as long as we've got sufficient income to justify the contribution, we could, in theory, go back 3 years. And if we've not made any pension contributions for the previous 3 years, we could pay 40, 40, 40 and 40 for the current year. So £160,000 of gross contributions. The only requirement is that you must have had a pension arrangement in place within that period of time. You can't just decide without having made any pension contributions to a plan before now to suddenly drop in £160,000.
Oh, that was just so cool, wasn't it, Sandro? Mm-hmm. Okay, well, we were going to listen to poor old Jason Donovan, but he's been a casualty of our verboseness. Mm-hmm. So we'll see you after the break. Anyway, welcome back, listeners. This is Financial Forte, and it is 1:08 now. Yeah, hope you're still awake. You've got the very intelligent Alessandro with buffoon Paul here today. So hope you're enjoying our show. We try to make what could be a dry subject slightly more exciting. So, pensions.
Yes. So we talked before the break about maximum pension contributions, and we've agreed that it's £40,000 or 100% of one's income, whichever is the lower. You can go back up to 3 tax years, providing you meet certain criteria. We call that carry forward because it's much more confusing because we're going back in time. And then there's another thing called the money purchase personal allowance. And people say, what on earth is that? And basically, when pension freedom came along in 2015, again, in its wisdom, the government, HMRC, decided that what they wanted to do was try and limit the amount of pension contributions wealthier, higher earners made. And so what we've got is this thing called pension tapering, which is basically means, Paul, that for every £2 of adjusted income, and adjusted income, by the way, is all income, including pension contributions. So for every £2 of adjusted income over earnings of £240,000, so some of your listeners may well be affected, the annual allowance, the amount you can pay in, is reduced by £1. So what that really means in simple English is, if you're lucky enough to be earning more than £310,000 a year, the maximum amount of money you can pay into your pension is just £4,000. And that same £4,000 limit applies if you are already in receipt of pension benefits. Maybe you previously worked for the government, the NHS, teacher's pension, for example, and you're drawing benefits but still carrying on working, maybe as a self-employed person. £4,000 is the maximum you can pay, but it's £205,000 of annual earnings if your employer is making contributions. And the reason for that is that the pension contributions increase this adjusted income thing. So for somebody earning £205,000 where there's pension contributions from employer, it's basically limited to £38,333. And I won't even go into the whys and the wherefores and all the technical information, but that's the money purchase personal allowance in a nutshell.
Something I wanted to ask you before the break was, so I presume this £1 million cap was introduced not very long ago.
Yes, it's really as part of the pension freedom reform.
Or lack of freedom, you mean?
Lack of freedom. It started off lower than 1,073,100.
What if you already had £10 million in there?
Oh, then you're okay. Now, one thing we weren't talking about today is personal protection. So there were protections that you could elect to introduce to protect yourself from this excess tax charge that I mentioned before the break. Again, not planning to cover those today because we can go in 100 different directions with pensions. But if you were lucky enough to have built up substantial pension benefits, then you had the opportunity back in 2014, 2016 to elect to protect those from this excess tax charge.
And one presumes, so if you took someone like me who takes pension planning quite seriously, so I am a good role model actually. So I actually started my pension plan, I think in the first week of Aspen Weight, even though I had no money really.
I started my first pension plan at the age of 21.
And of course my pension plan is managed by Sandro. And I did have 3 separate plans, I think, and Sandro has merged them into one. So I now have one policy, don't I?
Yeah, and that's a good point, actually, because I'm sure people will seek advice or be getting advice from advisors. We're not always advocating that people merge pensions, and we're not necessarily advocating that people take money out of final salary. They're called defined benefit schemes. So we're not necessarily advocating people to do that either. But there are lots of reasons why one would. Maybe because they're not getting very good returns wherever they are, or not getting service or advice, or in respect of final salary schemes, I'm thinking of companies like BA, Lloyds Bank. A lot of these schemes are in quite some financial trouble, and a lot of people are worried about those benefits being compromised, or they simply want to protect death benefits. We'll talk about those in a minute, because last month, if you remember, we talked about inheritance tax, and there's a very clever little form of inheritance tax planning we can do with pensions. So we'll talk about that, I'm sure, probably after the next record.
Yes, obviously one of the things I try to do on this show is to sort of give the informed layman's view. So, what people should do in practice. And I think I'm quite a good role model because, I think one of the things that's very important as a human being is to recognise yourself. So I've never historically been much of a saver, but I am good at long-term saving. Do you see what I mean? Mm-hmm. So when I started off, I started off my pension plan, and I think it's a very good tip, this. So I elected for the 10% index linking. So my pension has gone up 10% automatically for, best part of 30 years. So, of course, I'm making probably 4 times the contributions than I was when I started. Mm.
That's actually a very good point. And if you remember, in the very first show we did together, Paul, I mentioned one of the top financial tips for future success, financially at least, was this 10% rule. And the whole premise behind that is that actually if we were to carve out 10% of our income every single month and put it to one side, it might be painful for a couple of months, but it's a bit like moving into a house. You end up filling the house, and when you move out you think, goodness, how am I going to move all the furniture somewhere else? Okay. The 10% rule is basically this premise that if you carve out 10% of your income and put it to one side, whether it's in a pension or a savings plan or ISA, whatever it happens to be, you soon kind of grow around this new income, albeit 90% of what you were earning before. But we do cut our cloth. It's something that we do naturally. And since the age of 21, as I've already mentioned, I couldn't afford anything when I took my first job on. But somebody said to me, the power of compound interest is so powerful that even if you start off, as I did, with £50 a month, couldn't afford it, but struggled through, paid it every single month, and just like you, this indexed amount where it grows automatically, plus my growth, plus growth on growth, and all of a sudden you end up with a very substantial pension fund.
Yeah, so it's just being smart, really, isn't it? And I think also, so one of the things that I'm concerned about is the growing number of people that, so you would be such a person, I believe, without picking on you, Drew, who's made inadequate provision. And the way I tend to look at it as well is, although I've never naturally been a saver, I do have a very strong sense of responsibility to people that are reliant on me. Mm-hmm. So, for instance, this is slightly analogous. When Sam and Callum were born, I took out a baby bond for them both. As you know, because you did it, my granddaughter now has a baby bond, which I pay into. And I just think that's really smart. So instead of, turning around and going, hey, it's Gramps here, little Evie, you're going to university, here's a cheque for 20 grand. I think I'm paying £400 a month or something. I think it's something like that, and that will be obviously for for 18 years. So it should be a considerable amount of money. Very
tax efficient and a very good way of passing on one's wealth. Missing a generation, that's very good from an inheritance tax planning perspective, as we mentioned last month.
Yeah, miss out the generation, miss out the boring ones. Just give money to people that are fun. That's what I say.
Well, I have a great relationship with my two grandchildren, Tyler, who's 6, and Ivy, who's 2.
Hello, Tyler.
And they are the apple of my eye. And as we all know, if you're a grandparent, you have a very special relationship with your grandkids because you get to give them back at the end of the day. But you have a very, very good relationship with them. And I can think of nothing nicer than creating this legacy that my grandkids remember their grandpa or granddad. They call me different things. Creating a legacy where they can always remember me after I've gone, either because I funded their education or bought their first house. I really like the idea of, my kids are going to do plenty well enough, but to do something for my grandkids is very nice.
If you were my granddad, I would expect you to give me ice cream.
I can't even picture me being your granddad, Paul.
Well, that's the whole point, Sandro, isn't it?
That would be a very interesting dynamic, wouldn't it?
Well,
taking you by the hand down the promenade, buying you fish and chips and an ice cream.
Would you take me for a donkey ride?
I'm not even going there.
For those of you who haven't heard this story before, we were at Octopus Investments once. Do you remember that?
I do.
In the city. Sandro very kindly asked me to speak at an event that you co-hosted with Octopus.
You did a very good job, I have to say.
And he stood up in front of all these exalted people and he says, and our next speaker, he says, I'm not going to even bother to tell you where he comes from. Something like, ooh, are, you said, didn't you?
You'll guess within a couple of seconds.
So destroyed my reputation before I even started.
That's that dollop of cheese comments come from. It just is payback after all these years.
But to be fair, that's actually a true story. I remember this very well. Within seconds of me finishing my speech, 7 people came up and asked to see me straight away.
And if I may say, it's because you demystified the whole thing around tax. And I think, in my experience, Paul, people don't want to know what you know. They want to know what they don't know. They want you to make the complicated simple. And that's all I think we've ever tried to do, which is why you were surrounded at the end of your little presentation.
Mobbed all night long. This is a public announcement from Mr. Paul Waite. We have finished our homage to Stock, Aitken and Waterman and started one to Tamla Motown. That was the wonderful Ardeen Taylor, who of course was the only white artist signed to Tamla. So those of you who aren't fully familiar with Aspen Waite Radio and all the wonderful things we do go on to Aspen Waite Radio and click on to the website and look at click on me as a presenter. And if you go back to last Saturday, which was what was the date of that? 2nd, was it, or something?
6th?
First, maybe. 8th. No, 8th it was. Sorry. Yeah, sorry. Then you can listen to my Tamla Motown special, which has Ghost in My House by Ardeen Taylor, for instance. Anyway, so we're obviously very proud to bring you this show, and one of the whole point of this show really is to educate and advise you, introduce you to the wonder that is you, Alessandro. the wonder of you. So how do people get hold of Sandro? How do they contact you?
So my business, Forte Financial, as you would expect, Forte-Financial is the website. People can email me, Sandro at forte-financial.co.uk. I've got my own personal website, which is where I do my speaking and lecturing. That's Sandro Forte, and it's Sandro Forte on most social media channels as well.
Bellissimo.
Grazie.
Prego.
So I thought maybe, if it's okay with you, to your point, yes, we are trying to educate, demystify, make things a little bit more fun, less dry. But I'm also very keen to try and bring one or two tips and ideas to the listeners. So one of the things that I will just flag that is worth everyone having a think about is if there are any existing pension arrangements in place, have a look at whether or not one has a nomination form in place. And a nomination form, generally speaking, whether you've got a defined benefit scheme, whether that's a final salary or your own personal pension arrangement, there's something called a nomination form. And what it does is it basically tells the trustees, which typically are your former administrators in your old company or your personal pension provider, who they pay the death benefits to. And we'll talk about death benefits in a moment. Even drier subject, one that not many people like talking about, but very important. A nomination form simply says, if anything happens to me, I want my pension benefits to go to ABC. And that might sound really, really simple and straightforward, but the number of people who die and the trustees have no idea as to where that money should then go causes all kinds of complications, arguments, falling out in family. And there's another little thing called a spousal bypass trust. It's a very, very good way of keeping inheritance tax away from HMRC's grubby mitts in terms of future generational planning. So let me give you for instance, we've already talked about the fact I was your grandfather a moment ago, Paul, which is worrying. But let's imagine now, even weirder, let's imagine we're married and something happens. Why do I do this? And something happens to me. I've got 1,073,100, nice figure, that in my pension, which then passes to you. You're my wife or common law husband.
Oh, darling, thank you.
And you inherit that money. You inherit it inheritance tax free because you're my spouse or common law partner.
I think you stop now. It's getting me excited.
But if anything then happens to you, our children, if we've got some, will inherit the 1,073,100, but they will pay inheritance tax on that money because it's no longer part of your estate. It's come out of your estate. So the way to avoid that happening is to create what's called a spousal bypass trust. And what that basically means is I create a trust around my plan that says I give everything to my darling wife, Paul. But if anything happens to him, all the money stays in the trust. The kids can then go to the trust in future. The money never technically belonged to you. It always stayed in the trust. So generation after generation after generation, until the money runs out, can access the trust without generations paying inheritance tax multiple times over.
Something I just thought about. Sorry, going back to something you were talking about earlier. Doesn't the percentage of contribution reduce when you get to a certain age? If you're still working? In terms of how much you can pay into a pension? No. So the levy is now, 13.3% or whatever.
National insurance?
Yeah. But I think that falls when you get to an age of 65 or something.
It does. It does. You pay a reduced amount of national insurance, and then eventually you pay no national insurance. Yeah, we weren't going to talk about that because we're going off in a completely different direction. But you are right when you get.
Sorry, I just have to clear my mind, man.
Yeah, you're right. Absolutely right.
You did pollute my mind with being married to you, and the thought of having your children and a lot of money was.
I don't know why I use that as an example.
No, what do I? No, it's because you have secret pent up thoughts. That's why.
Oh dear. So yeah, spousal bypass trust, very good inheritance tax planning tool for pensions. Nomination forms, just a basic principle to make sure the money goes where you want it to go. And then I thought what we could talk about briefly, Paul, is drawdown, because this is the new flexible pension arrangement that a lot of people get their knickers in a right old twist about. And so what I thought I'd try and do is to demystify this one as well for us, because I had a conversation only yesterday with an individual who lost their father at the age of 75 years and 2 months, and that was quite significant from a pension benefit perspective, which we'll talk about, I'm sure.
Is that it?
Well, we can talk about it now if you like. I just thought there might be another record coming up.
Bit of a teaser.
You keep telling me off for talking for too long.
No, we're only on 6 minutes, Sandro,
Okay.
so you can talk for another 4 minutes.
Oh, excellent. Okay. So, drawdown, the new flexible form of pension arrangement. Let me take listeners back to a time in the past, probably when mum and dad were around, or grandparents probably. And the way that historically pensions would generally work is we build up this big pot of money in a pension, and then we came to the day where we decided to call it all a day and retire. And as I mentioned earlier, we take some tax-free cash from the pot, and then we take this thing called an annuity, which was a fixed pension income that was paid for the rest of our life. If we died, the pot died with us. But it was great in the old days because annuity rates were high. And when annuity rates were high, 8%, 9%, 10%, I could invest £100,000 and receive £8,000, £9,000, £10,000 a year forever. And it was great. I'd only have to live 10 years to get all my money back. Now, annuity rates are very, very low. And as a consequence, annuities have become very unpopular. Very, very rare circumstances where you would...
Will not inflation drive that back up?
Eventually, we will see annuity rates rise again. But for the moment, a bit like interest rates, annuity rates are very low. So you wouldn't want to fix a payment in the form of an annuity via a pension, because you'd be hamstrung with a very low amount of money and not be able to change it. So the new pension rules allow us, if we've built up this £100,000 pot, as I mentioned, we take the £25,000 of tax-free cash if we decide to do that. And I would just add a little point. You wouldn't want to take the £25,000 of tax-free cash and just stick it in your bank account. Why? Because £25,000 has now passed from an inheritance tax-free environment to an inheritance taxable environment. So you only want to take what you actually physically use.
Unless you don't die, of course.
Unless you don't die. But if you think about it, keeping the money in a pension growing at, let's say, 6, 7, 8% versus sticking it in the bank account and just sitting on it earning 0.1%, that makes no sense financially. And you can draw on that tax-free cash at any point. You don't have to make the election when you retire. So this new form of drawdown, flexible pension planning, allows us, instead of being hamstrung by an annuity, we can take any amount of income we want from that pot, whether it's £0, 10,000, 20, or in theory, going back to my earlier comment of 100,000, we could in theory take the whole £100,000 out in one go. £25,000 of which would be tax-free, £75,000 would be taxable. Why would you do that?
Taxable at what rate?
Well, in this example, it would be taxable some at 20, some at 40, because it would be treated as earned income. Okay. So we'd have a personal allowance, 12,570, as I've mentioned, then some at 20, then some at 40. But why would you take the whole pot out in one go? Well, terminal illness, you're given a very short timeline in terms of life expectancy, and you just think, I'll pay the tax and have some fun.
You have terminal illness and you get the money and then you don't pay the tax. Yes, sold the tax.
Well, there'll be a claim against your estate, so somebody would have to pay it.
You don't care.
Well, so the reason I mentioned 75 years and 2 months, 75 is a pivotal age. So what happens is, if someone owning a pension pot of whatever description dies before the age of 75, the people who inherit that money get 3 options. They can either buy an annuity, as I've mentioned. They can take the whole pot as a tax-free lump sum, which is great, obviously, subject to the fact that the money now flows into their estate for inheritance tax purposes. Or they can take flexi access drawdown, which is like a form of pension, stepping into the shoes of the deceased, basically.
I got another announcement for you, Forte. If I was your wife, I would only want to be your part-time lover.
You're not going to let that go now, are you?
It's the wonder of me and Stevie. Well, I don't know. I'm trying to forget about it, to be honest.
No, you're not.
Anyway, welcome back to As Per Waite Radio, and this is Financial Forte with Paul Waite and Sandro Forte. And we're coming into the last 10 minutes of Advice from Alessandro today.
Tell me, hasn't that time flown? Well, it has for us at least. I'm not sure about the listeners. So let's, because the next obvious question is, so what happens if I die after 75?
Sorry, I was supposed to say to him, what happens if you die after you're 75?
As you say, Paul, the beauty of live radio.
Thank you.
I only gave him one instruction today. So die after the age of 75. What happens then? Well, you lose the opportunity to pass on your pot of money in your pension entirely tax-free to your next of kin. You only then have the annuity option, which we've already agreed isn't a good one at the moment, or that flexi access drawdown option as before. I've also had a couple of people mention to me, so I've got to state pension age. I'm 66, but I don't want to draw my pension right now because I'm still got some consultancy work. I've got enough coming in, maybe from investments or other work. Can I defer my state pension? The answer is yes, you can. And to put that into monetary terms, if you were to, for example, defer the current state pension of £185.15 by just 1 year, you would see your pension increase to £195.89 per week. So deferring can...
They do actually do an actuarial calculation to adjust your fund, and every person has got their own unique pot.
Yeah, well, obviously the deferral figure starts at age 66, and they obviously know that the life expectancy for a man is X and the life expectancy for a woman is Y. So actuarially, you're right. They calculate on the basis that we are 1 year closer to the day of reckoning, and so on that basis, £185.89 is far fairer than giving you £185.15 a year from now.
Rather begs the question, so when you pass away, what happens to your pension?
It passes away with you.
Does it? So, because these are sort of things that people never talk about, really. You know, I often say this. You know, I think that when you're at school or college, there ought to be a life class. No, seriously. So, you know, if you just think about this sensibly, so on the face of it, you take your individual that's carrying on working, and therefore he's deciding not to take he or she has decided not to take the state pension. They get rewarded for getting another £6 or whatever the next year if they then retire then. But if, for instance, they were to die within, say, 10 years, that would be a bad decision, wouldn't it?
Yeah, there are. I'm answering a lot of these questions today, Paul, on a very generic basis because, as you will probably appreciate with all financial planning matters, there are lots of complexities. So there are certain circumstances, again, to add another caveat, where you can pass on some of your state benefits to your spouse, for example. But generally speaking, if you have an annuity, if you have a state pension and you die, those benefits tend to die with you as a general rule. The other thing that I thought I might just mention is something called lifestyling. Lifestyling is something I never hear clients and people I talk to ever mention because they don't really know what it is. Lifestyling is this basic premise that as we get older, we tend to have a greater reluctance to take risk. And if you think about it, especially what's going on in the markets at the moment, which are very, very volatile. If you imagine, let's say you're 64 years of age, so you know 2 years from now you are retiring from work, you are getting your state pension and maybe some pension benefits from your £1,073,100 pot that you've built up over the years. Would you want to carry on taking the higher level of risk that you took as a young man or woman? Maybe you're investing in equity, stocks and shares and had done very well historically. But as you get closer to that day where you call it a day, would you want to carry on with that kind of same risk profile that you had for the last sort of 20, 30 years? And the answer, generally speaking, is no, you wouldn't. So lifestyling is this basic understanding of a movement towards or away from a higher risk investment profile to a lower risk investment profile, and you do it on a stage basis. So good financial planners or people that manage their own investments and have a good deal of understanding of these things will generally start to de-risk over the years leading up to their retirement. Taking that one stage further, let's imagine that somebody was retiring today. And 1 year ago, when stock markets were performing a little better, they were looking at their pot thinking, oh, great, I've got 1,073,100. And today it's worth 950,000. If they then take an annuity or they start to draw benefits, they're drawing benefits at a lower amount than they had just 1 year ago because they didn't change the risk profile of the underlying investments. So that's something we call lifestyling. And every bit as important as the spousal bypass trust, the nomination forms, checking your state benefit forecast on the gov.uk website. Just a little tip, something to ask people to bear in mind as they approach their retirement years.
That's a good point, actually, because I was just thinking about myself that so my monthly payments would be probably over £2,000 a month less today than they would have been 3 years ago, for instance, because things like mortgages have come to an end. So actually, my outgoings would be massively less, but I don't really think about it. Actually, I haven't formally sat down and thought about it, other than my brain racing listening to you.
and still dwelling on the fact that we might be husband and wife.
You're not going to let that go, are you?
Well, you're not. But no, you are. You're absolutely right. And when people say, "How much do I contribute to a pension? How much do I contribute to an ISA or put aside for the grandkids?" The answer is whatever you feel comfortable with. And it's a conversation you and I have had, Paul. There is no right and wrong. The toughest form of any kind of financial provision for the future is one where every month you look at your bank statement and think, I'm really struggling to pay that. So, although we will actively encourage anyone to pay in as much as they can, again, to use that word, there is a caveat that says only if you enjoy doing it, because if it's a struggle, you won't enjoy that process. So something that's comfortable that you can build up over time. And a lot of self-employed people say to me, what should I pay? I try to discourage people from tying themselves down with a regular monthly payment unless it's very, very comfortable. Very, very good way for self-employed people to invest in pensions is just to look at their taxable profit at the end of every year and make a lump sum contribution based on that profit.
Yeah, something I was just thinking about is good choices. So going back to the cap, the £1 million cap. So if you were in the situation where you were, you have or had or likely to breach the £1 million, but you didn't have an ISA, you'd actually be much better off starting off an ISA, wouldn't you?
You absolutely would.
And then you'd have the ISA and the thing, and they both would be tax-free.
Yeah, they would.
There we are, see.
Yeah, I mean, that exactly, and that's what we do. I've got a client at the moment who's got a fund of £895,000. If he carries on funding at the level he's been funding for the last 20 years, he is going to breach the cap. And then what we're saying is, well, what's the point in paying 55% tax on what should have been tax-free cash? And what's the point in paying an extra 25% income tax? Why not just forego the tax relief now and redirect your money into an ISA? The only downside is that he has an inheritance tax problem. So by putting money into ISAs, he's creating a bigger inheritance tax problem for himself. But you're absolutely right.
Here's a really smart question for you, Forte.
Oh, no.
Right, so you're in the 55% bracket. Do you qualify for 50% seed enterprise investment scheme relief on that? If you made a qualifying investment?
If you're in... Repeat the question. 55%.
So you're paying 55%. You said on the excess.
Yeah.
Do you get the EIS or SEIS tax relief on that if you were to use your money to invest in qualifying businesses?
No, I don't think you do. But I do need to check that because that's a very, very intelligent question.
I know, I try.
But I don't think you can offset one against the other. Though you are paying on the 25%, you should be able to
definitely,
to claim. But on the 55% tax-free cash excess, I don't think you can. But I will come back to you next month and give you the definitive answer on that one.
Okay.
Just goes to show I don't know everything.
Well, I
love that question, though. Yeah, I know you did. I knew it as well. I'm not sure why I mentioned that.
You've got 30 seconds before I'm wrapping up today's show.
I've got nothing else to say. I'll tell you what I will say is that we had a conversation during one of the links, and we've decided that next month we're going to talk about SIPs and SASs and defined contributions versus defined benefits, and I'm going to try and demystify all of those as well.
I mean, obviously, the listeners now are just beside themselves. It's like looking at a steak through a glass window, isn't it? Oh, Sandro, please talk about SASs now, will you? Please. Okay, well, no, I won't, because I'm Alessandro Forte, and I could go on holiday in Barbados where you are all at home.
Always leave them wanting more.
Yes. Anyway, thank you very much, Sandro, for your expert tips today and your disturbing comments, which I will try not to have nightmares about this evening. This was the Paul and Sandro show, Financial Forte. Today we brought you our little homage to Stock, Aitken and Wortman, and just a little journey down the Tamla Motown route. We've really enjoyed the show, and we'll be back next month. And I'll be back tomorrow with Nathaniel on Scenarios.
Financial Forte. Listen in, ping-a-ling-a-lo to our radio show. Financial Forte. Financial Forte.